Good afternoon, ladies and gentlemen, and welcome to the K3 Capital PLC final results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. And if you just take a moment just to see where that is, it's on the, as I said, on the right. And then if you type your question in the box at the bottom and then press send, the company will see your questions directly. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. And I'd now like to hand over to John Rigby, CEO, and Andrew Melbourne, CFO of K3 Capital. Good afternoon, guys.
Good afternoon, and thanks for the introduction, Mark. Okay, so for those of you who haven't met or spoken to us before, my name is John Rigby. I'm the CEO of K3 Capital Group PLC. I've been with the company in its former guises for 20 years now, formerly within the sales side of the business, progressing through to sales director, and then became managing director in 2010, where we very much reshaped the group and the operating nature of the business, and then grew it through from 2010 to 2017 when we floated the business on AIM in April 17. Subsequently, obviously, growing the business since, and more recently, which we'll talk to you about later, the recent fundraise and the 2 acquisitions that we've concluded through the summer. I'll just let Andy introduce himself before we go on to the presentation itself.
Good afternoon, everyone. I'm Andy Melbourne, Chief Financial Officer. I joined back in 2012 as Financial Controller and clearly have grown with the group. Historically, I've been involved with all things financial. I've also taken part in a number of transactions with clients, helping oversee the growth of the CF Light departments and some of the sort of 2 to 15 million transactions. And going forwards, now part of the wider group, concentrating on pulling all the finances together of the now enlarged company.
Okay, so the nature of today's presentation is really firstly to cover off the performance of the M&A business for FY20. Clearly, the business has changed somewhat since year end, so we want to talk to you about the performance of the M&A business first, and within that we'll cover the impact of COVID, how we've mitigated that, and some positive statistics around the speed of recovery and how we've come out of that curve. Then we'll move into the acquisition phase and talk to you about the recent acquisitions of Rand and Quantuma, which were completed at the end of June and the end of July, respectively. Then move into sort of talking about the strategy of the now enlarged group and some of the quite exciting growth plans that we have for that enlarged business and how we drive value out of the 3 businesses coming together, before finishing up with an update on current trading for Q1, and then obviously answering any questions that there may be across the listeners. Okay, so if we concentrate on the business highlights page there. So firstly, in relation to the year ending May 20, we're delighted to be reporting strong performance with an increase in both turnover, which is up 10% to 15 million, and EBITDA, which is up 36% to 6.8 million. This performance, obviously, despite a very challenging final quarter on the back of COVID and specifically the UK lockdown, without which this would certainly have been a record year for the group in relation to both revenue and profits. The first 9 months of the financial year, so to Feb 20, saw us continuing to deliver on our strategy of driving both the volume and the value of the transactions we facilitate, and saw growth across most major KPIs across the group. Obviously, these were impacted with the March to May lockdown period, and we will show you as we go through the presentation a bit more detail around the actual impact that had and what the post-lockdown recovery looks like. We were again delighted to have been or retained our #1 status amongst our peer group, and we've been ranked for the 3rd year running now as the UK's most active deal maker, seeing us close 22% more qualifying transactions than KPMG, who again appeared in 2nd place, and the league tables we'll show you further on in the presentation. We're very proud of how we as a group dealt with the unprecedented, unexpected challenges brought about in the final quarter. And I think this for me underlines the robust and nimble nature of our business model. The speed and the agility of the business and its people to cope with rapidly changing conditions, together with the support and commitment shown by the senior team in the cost reduction, salary and bonus sacrifices which were implemented, which when we combined that with utilising the coronavirus job retention scheme, meant that we were able to remain EBITDA positive, minimise redundancies, And this was this EBITDA positive nature was done despite the fact that we recognised no deferred revenue in the final 2 months of the year, and essentially many of our sales staff were grounded. So we're very pleased with the fact that we remained profitable throughout that period. This year's performance has very much been underpinned by a significant growth in transaction fees, which are the fees that are gained when we complete a transaction. We saw a significant 56% increase from 5.4 million in FY19 to 8.4 million in FY20 this year. That statistic is even more pleasing when you take into account that growth came despite that very difficult final quarter, and indeed that growth also came across all three divisions. So the Knightsbridge division, the Kbs corporate division, and the Kbs corporate finance division all saw growth in transaction fees across the period. Just a reminder for those that don't know us too well, the three divisions of the M&A business, essentially we have Knightsbridge, which deals with enterprise values typically 0 to 1 million. We have Kbs Corporate, which is our corporate broking brand, which is from 1 million through to around 15 million. And then we have the corporate finance business, which is from 15 million through to north of 100 million. So those are the three divisions that I refer to there. What the board and group have achieved since year end has been nothing short of transformational. We identified and shortlisted our preferred targets. We raised £30 million and then deployed that capital swiftly and effectively across 2 acquisitions, which has created a hugely exciting and high growth group of complementary professional services businesses. It's diversified our offering away from a pure M&A play. So historically, there has been those that have questioned the cyclicality of our business, which I think we've very much defended in terms of the nature and the spread of our business. But we very much diversified away from that pure M&A play. We've added a counter-cyclical business in terms of consumer advisory. We've added a contracted and recurring revenue business in Rand, and created a clear strategy of how we now accelerate the existing growth of those businesses through utilising the different skill sets and the different client acquisition methods of each business for the benefit of the wider group. And this combined gives us a greater degree of predictability and visibility across the now larger group. It gives us a far more exciting future, given that as a pure M&A business, even our pre-COVID forecast in the market were 3-year revenues of 18 million, 19 million, 20 million, generating profits of 7.5, 7.8, 8.2. And the current 3-year forecasts in the market show revenues of 35 million, 47 million and 58 million, set to produce profits of 10 million, 40 million and 18 million respectively. So significantly more scale across the group now. I'll just pass you over to Andy to chat you through the financial highlights on the next page.
Yes, the financial highlights. We're delighted again to report this 10% increase in revenue for FY20, rising to £15 million based on last year's results of £13.6 million. This has seen increases out of 4 of the 5 revenue streams within the group, despite there being no retainer fees being recognised in the final 2 months of the period, as we'll explain later on. This result of £15 million is the second largest turnover in the history of K3 Capital Group, compared to FY18. However, in FY18, of the 16.5 million turnover, 40% of this came from a small number of significant corporate finance transactions, whereas FY20 sees over 80% of revenue coming from the volume brands in Kbs Corporate and Knightsbridge. When we consider that in FY18, corporate finance generated £6.6 million of income versus the £2.9 million of this year, it's quite clear to see there's still some great upside potential from this department, whilst we can now rely on the security of volume to underpin future expectations. As John mentioned before, FY20 sees 60% of group income coming from transaction fees, and as an M&A business, clearly that's what we set out to do, and these have grown by 56% on the previous year. So as this demonstrates the investment that we made into our service delivery over the last few years, improvements in buyer matching engine, in contacting buyers, in staff training and such like, has seen KBS transact more deals than the rest of our competition, ensuring the best results for our clients and driving this revenue growth. The increased revenue line has been complemented once again with a rise in EBITDA to £6.8 million, despite a flat final 2 months of the year. This is a 36% increase on the prior year, and again shows growing margins with EBITDA of 45% this year, thanks to our low cost base and agile business model. As always, KBS remains a highly cash generative business. It has minimal capex requirements and minimal working capital requirements. We managed to secure just 100% EBITDA to operating cash conversion rates. The year ends with £8.3 million worth of cash reserves, and when we take into account VAT, corporation tax and dividends, This leaves us with around £4.2 million worth of free cash, which we believe is sufficient reserves at this time. Earnings per share growth for the year, however, dividends per share take a small decline. This is due to the fundraise that we did over the summer, and now there are 68 million shares in circulation as opposed to the 42 million historically. In terms of the overall quantum of dividend, this year we'll be paying out circa £4.2 million, up from the 3.2 million last year, and we believe this is continued growth in line with the business. If I can just hand back to John in terms of the business process.
Yeah, so this double page spread really sort of recaps our business process. Those that have spoken to us before will know this. We refer to this often as the hopper or the funnel. And really it flows through from data and how we use that data within our marketing function, how the marketing function drives the sales function of the business, which delivers our first revenue stream, which is our retainer fees that come from mandating clients on the sales side. We then move into the operational phase, which is a 3-phase process of presenting the client's business for sale, reaching out and finding buyers, and then where appropriate and offers coming forward at the right level, delivering those transactions through to close, which generates our second revenue stream, which is transaction fees. So there's 2 revenue streams in the business essentially, which is the retainer fees when the client places the business onto the market, and the transaction fee should we get through to a successful sale. One of our key USPs really is around how we use data and marketing to drive the growth of the business. Unlike many sort of business brokerage, professional services, corporate finance businesses that are reliant on referral networks, introductions, reciprocity, seminar type models, our business has always been driven by high volume direct marketing, which we'll come on to. The technology sort of section down there really is just to show how and where we use some of our proprietary technology within the business. Probably the 2 main areas being Kpis Globe, which is a proprietary sort of CRM system that essentially manages all of our data, volume, direct marketing and sales functions of the business. And as we come down into the operational side, the blue box there, the BME, which is the buyer matching engine, which is again a proprietary piece of software that we've developed, which essentially uses algorithms and significant amounts of data to automate the process of putting our clients' businesses that are for sale in front of prospective buyers. And we'll again show you some of the statistics that's driving in the business as we move forward. The other areas there are the company valuation services and what is my business worth, which are valuation portals, which we use as lead generation portals. And then the mandate portal at the bottom is essentially a shop window to serial acquirers, family offices, private equity houses, and known PLC buyers. It gives them a portal, a shop window to be able to view some of our larger mandates. If we come across then to the blue arrows and just work through, and I'll give you a bit of detail around each. So essentially our business starts with data. We have a data set of approximately 4 million limited companies and partnerships. We have 4 people who work full time within the data function, and their role really is to profile that data, to append contact information to that data, and to cleanse that data such that it's of the highest quality it can be before we put it into our direct marketing function. We have circa 2 million of those at the moment, are what we term profiled seller targets. So those are companies that we've identified that we actually want to go after as a potential client. So in terms of advancements or any changes in the year, we've been able to add quality to that data in terms of the number of phone numbers and the number of email addresses that are appended to it. Essentially, that gives us more contact points to be able to speak to or email or mail a director or shareholder of one of these businesses and promote our services to them. We move then into direct marketing, and there are 6 real core sort of direct marketing channels that we've always utilized as a business, and I'll give you some scale as to what we do here. So direct mail, we send in excess of 100,000 pieces of direct mail each month. From an email perspective, we send typically in the order of about 1.5 million pieces of email marketing each month. We have the 2 valuation portals, which I mentioned before, one of which we promote through PPC, pay-per-click, and one of which we promote through email marketing, so they don't compete with each other. Digitally, we have a strong online presence. So if you go onto Google and search any of the key terms around selling a business, valuing a business, you'll typically find one of our brands close to or very near the top of Google. I'll just skip on to 6, which is telemarketing. We have a significant outbound telemarketing function within our head office in Bolton, typically around 40 seats at any one time, and they will be phoning and following up on a lot of the outbound marketing activity that we put out there as a group. And then lastly, remarketing. And this is essentially where we've been out to see a potential client in the past who has chosen at that point not to mandate us to sell the business. We collate all that data on an ongoing basis, which is a very rich vein of data for us and allows us to remarket our services to those people on an ongoing basis. One of the key elements here, which we'll come on to later, is how we utilize that data, those marketing skills, and indeed the Kpis Globe system that allows us to do that, is how we leverage that across the new acquisitions in order to drive growth in both of those businesses. And we'll come on to that later. In terms of the output of that marketing function, it typically generates for us around 600 qualified appointments per month. So we have 2 sales teams, one within the Kpis corporate business, one within the Knightsbridge business, who then go out and attend those 600 qualified sales appointments each month. Obviously, during COVID, we've transitioned some of that into online selling. So some of those are still being done face-to-face. The majority of them for several months now have been being done via Zoom. And it's one of the key strengths of the business of what we've done this year. We've transitioned all of those salespeople and retrained them into being able to present and therefore mandate those clients remotely. And we're really pleased with the results that are coming out of that. So all of that delivers mandates into the operational side of the business and delivers a revenue stream into the business. That revenue stream typically covers all of our fixed costs, our payroll costs, and our marketing costs across the group. So essentially, we get to a break-even point before we've actually then gone on and sold the business. From an operational point of view, as I said before, it's a 3-phase process. We present the client's business for sale through a very attractive information memorandum. So high quality documentation to present the client's business in the best possible light. Buyer reach is really the key function there, and we have a piece of software there called BME, which essentially automates the process of locating and contacting potential buyers of that client's business. So it's a piece of software that we've built over several years now, which essentially replaces the traditional role of a researcher. So if we look back historically, a researcher would spend several days compiling a list through desk research of potential buyers for a client's business, and then would probably spend another couple of days picking up the phone and trying to contact those buyers and try and get a teaser document in front of them, which is a generic summary of that opportunity. We can now, at the press of a button, we can automate the creation of that buyer list through use of algorithms and big data. And then equally, we can automate the process of contacting those prospective buyers. We introduced that software about 2 years ago, and we've seen a 3- or 4-fold increase in the number of buyers that we now register across the group. Because we're registering more buyers, essentially we're creating more buyer meetings. So arranging last year in excess of 500 buyer meetings per month between our client, the seller, and a prospective buyer. From those buyer meetings come offers, and in excess of 100 offers per month, which is significantly up on prior year. And from that comes then agreed deals, which then go into a WIP pipeline and ultimately convert into transaction fee income, which is the second revenue line. So that hopefully gives you a reasonable overview of the business process from start to finish, and how some of the technology that we have is being used to drive volume through that funnel, through that hopper. Okay, and just to pick up on some of the key performance indicators, KPIs across the business, and the first set of 4 here relate to the sales side of the business, which is what we relate to the winning of new clients, if you like, mandating new clients. And the 4 key things that we measure there are the number of new business appointments that we generate and attend as a sales team, the value of retainer fee quotes that we quote to those appointments that we see, the number of mandates that then we convert from those appointments, and then the revenue that comes from those mandates. And what we've tried to do here is in the graphs on the left-hand side to show you the progress of the business from 18 through 19 through 20. And then in the graph with the lockdown, shaded lockdown bar in there, is really to show you the impact of lockdown on that particular KPI, and then equally the impact of when we reopened the office in June, and the return to form, if you like, since then through June, July and August, Q1 of this financial year. So as you would imagine, all of these graphs follow a very similar pattern, indeed almost identical. And that really relates back to the fact that all of these are driven out of the number of appointments that you sit, which has always been one of the key drivers of the business. As you can see, pre-COVID, we were growing that, and FY20 was ahead of 19 and indeed 18. When lockdown came along in late March, that literally dropped off a cliff, April and May being very, very low. And then as we reopened the office, in June, and started with our marketing activities again, we quickly picked up to sort of getting somewhere near the pre-COVID levels. Because of that, our quotes follow a very similar pattern. Our client mandate numbers follow a very similar pattern, and equally the retainer fee income that comes from those appointments follows a very similar pattern as well. Just to attach some actual numbers to that. So when we came back in our heyday, at absolute best, we were probably generating around £160,000 per week in retainer fee revenue, so running somewhere around £8 million per annum. Clearly that dropped off a cliff during lockdown. As you see, since lockdown picking up nicely, in June it was running at £50,000 per week. In July it grew to £80,000 a week. In August up to £100,000 a week, and in September, hot off the press, running at about £125,000 a week. So a much quicker return to something like form than we ever envisaged when we were in the sort of depths of the lockdown. I think the key reason for that is that we transitioned all of our salespeople to be able to sell via Zoom. We retrained them. We redid all our presentations to be Zoom compatible, and we train those people in how to close those mandates remotely. I think also the sort of shift in mood of the UK SME business owner to potentially accept buying professional services in such a way, something probably which we would never have deemed possible before the current crisis and pandemic that we've seen. So really pleased with how the business has reacted to and come out of that lockdown period by transitioning into a sort of remote selling function. One of the key attributes of that is that one of our sales guys or our regional corporate directors previously would have only really been able to attend 2 appointments a day because of the traveling time and mileage in between those appointments. They can now typically do 4 appointments a day via Zoom. So that's allowed us to reduce our fixed cost base, yet still be able to cope with the same level of sales appointments, and indeed going forward give us a capacity to potentially increase how many new clients we can present our services to on a daily, weekly, monthly basis. The next set of graphs, thanks Andy, is around the operational KPIs, and these really are driven through the number of buyers that we register within the group, which is NDAs as we term them, non-disclosure agreements, how many buyer meetings come from those NDA registrations, how many offers ultimately then come from those buyer meetings, and then the revenue that comes from completed transactions. So again, if we look at those, as you can see from the top graph on the left hand side, buyer numbers, because of the BME software, were growing very, very well through the last 3 years. And you'll see from the January number there, in excess of 4,000 NDAs, so well above the run rate even for FY20. They dipped off during lockdown, not as marked reduction as in the sales side of the business, dropped down sort of 2,500, and then have picked up again since. So again, a pretty rapid return to something like form from June onwards in Q1. As you would imagine, buyer meetings have followed a very similar curve. Again, offers that come from those buyer meetings have followed a very similar curve and indeed recovery. And the transaction revenue that then comes from those businesses. Transaction revenue always jumps up and down a little bit. You can see there the stats that we mentioned before. FY20, we did 8.4 million versus 5.4 million the year before. As Andy mentioned, a lot of that coming from the volume brands of the business, so coming from Knightsbridge and Kpis corporate, rather than, as we saw in FY18, a couple of or a handful of a small number of very large transactions impacting that number quite significantly there. But a couple of highlights of Q1. If we look at June, June was a strong month at circa 700k, which was in line with the average of last year, being 8.4 million across the 12 months. August as a month was a record ever month for Knightsbridge in terms of the number of completions and the value of completions that it concluded within the month of August. And across the group, we completed as many transactions in August as we did on average across the whole of last year. So hopefully those graphs will give you some flavour for how the business was impacted by, and indeed more importantly has recovered post the lockdown in Q1. And again, we'll give you some stats around Q1 trading performance later on in the presentation. Okay, those are the league tables. These were Thomson Reuters, now Refinitiv, having acquired Thomson Reuters league tables, and these are within the small mid-cap market. As we mentioned before, this is a league table of, I think, the top 50 advisors in the UK. And this is just an excerpt of the top 10. We've topped that league table now for 2017, 18 and 19. And these relate to what they term qualifying transactions. So a lot of the smaller transactions that we do aren't included within these sort of league tables. This tends to be the larger corporate and corporate finance transactions that sit within these league tables. But clearly a very useful marketing tool from us, where we can promote our name up there, ahead of the likes of KPMG, PwC, Rothschild, etc. Very, very pleasing for us to see ourselves there. I'll just pass you now to Andy just to chat you through in a bit more detail around, again, keeping in mind this is in relation to the M&A business pre-acquisition, to just chat you through the P&L, the balance sheet and the cash flow, and then we'll come on to the acquisitions phase.
Thanks. Yes, starting with the profit and loss. In terms of revenue, just a recap, we have two income streams into the business. The first one is retainer fee income. So this is typically a one-off payment made in advance of service from our clients that we recognise over a period of time. In Kpis Corporate, that's over a 6-month period, and in Knightsbridge, that's over a 12-month period. So starting off here, this is the only negative financial points in the reports that we see retainer fee income decline by 18% in the period. Clearly, the impact of the national lockdown grounded our sales force, which meant that we weren't sitting as many new client appointments as we've seen in the previous graphs. And also our operational staff were faced with clients who were asking us to pause the process as matters unfolded. Due to this, we made the decision to suspend our revenue recognition policy for the lockdown period, which was the final 2 months of FY20 and the first month of FY21. There were some positive 9-month stats to February 20, as John's talked about before, included increase of appointment numbers and fee quotes, and fee income broadly in line with previous years. Our second income stream then is transaction fee income. Just as a reminder, transaction fee income is only recognised when a deal completes. There's no accounting for any work in progress. There's only upside when deals complete. This year has seen all three transactional lines improve on the FY19 and some significant increases in KPIs, even for the full 12-month period, including lockdown, notably the 34% increase in the number of buyers signing NDAs in the period. The largest revenue increase comes from the CF department, recovering from the rather disappointing £0.8 million last year to deliver £2.9 million in the period, with a 60% increase in the number of transactions completed. Kpis Corporate also sees a 19% increase. This is partly due to the continued development of what we term the CF Light department. This has delivered £3.3 million worth of income in FY20, which is a 30% increase on FY19. This sees the volume and value of the circa £2 to £15 million transactions continue to grow, and further proves the model of adapting the best of brokerage with corporate finance support will help drive the volumes of the less complex transactions at these levels. In terms of expenses, marketing expenses for the year are reduced by 12% due to the significant scaling back of costs in the final 2 months of the year following lockdown. Clearly, as we expected, our sales reps to be grounded, fewer appointments, therefore we can turn down our marketing spend accordingly due to the agile nature of our costs and our contracts. This 3% also saw a decrease in fixed admin costs, which was a combination of the overhead reductions in the final 2 months, along with the significant personal sacrifices made by directors and managers, with reductions in both salary and foregoing annual bonuses due to the ongoing pandemic. The 4% reduction in variable costs, a little bit lower down, this is purely staff bonuses, which we believe is a further demonstration of our ability to continually align bonus schemes to market expectations. Despite an 11% increase in turnover, there's actually a decrease in the payments made in the year as we ensure that all members of staff in the business have reasonable basic salaries, but are very much encouraged to perform in line with market expectations every year, so that the people in every single one of these periods who performed well have earned well, and equally those who aren't performing, with our average salary across the group, including the PLC board at around £31,000, clearly make sure everyone is highly motivated. This generated £6.8 million of EBITDA and a healthy 45% margin for the period. So over the next page on balance sheets, it's a robust balance sheet. There's no debt in this business, and clearly with the deferred revenue line, there's some security over future performance. In FY16, for the May 31st balance sheet, the auditors have paid particular focus on goodwill and going concerns, I'm sure you'd expect. We're all comfortable with this group position. I'm quite proud to have the audit signed off on time with no adjustments and no concerns from the auditors that show that we've got robust structures in place. Total £9.2 million of equity is largely made up of cash balances, which are detailed on page 19. There are two main outflows of cash here in the period, which are tax and dividends. But as I mentioned before, there's nearly 100% operating cash to EBITDA ratio. And because we've got minimal costs that drop below the EBITDA line, we're highly cash generative, with £2.5 million being generated in the financial year. As I mentioned before, once we take into account things like corporation tax and VAT, we're left with just over £4 million of cash, which we take forward into the next period. I'll just hand you back to John in terms of the acquisition timeline.
Yeah, so that sort of brings you up to speed, hopefully, in terms of the M&A business for FY20. And we'll move now into talking a little bit more about the acquisitions and what we've been doing since then. So In quarter three of last year, the board were considering a small acquisition within the R&D tax reclaim space. The reason for that was that we liked the nature of the recurring and contracted revenues that such businesses have, and we felt that the SME client base had synergy with our own, both from a cross-referral of client perspective, but also more importantly, the potential for us to utilize our direct marketing, our data and direct marketing skills to be able to drive growth in such a business. Ultimately, we pulled away from that particular deal as we felt it was too small to be meaningful enough. However, that very much planted the seed for us, and the due diligence that we've done in that space had really only underlined our thinking that an acquisition of that nature would be a very good fit for the group overall. We'd also been discussing at that time the cyclicality arguments and whether we should also look at the insolvency space as something that would fit very well alongside the M&A business. So later on in quarter three of last year, we decided to use our term market map both the R&D tax space and also the corporate recovery and insolvency market to fully understand what the target landscape might look like. In quarter four, we then shortlisted and targeted a list of preferred R&D companies, and following in-depth discussions with several of those, we selected Rand as our primary target. We initially spoke to Rand on the 14th of May, and having conducted a number of workshops across key areas of the business, we agreed heads of terms with them on the 27th of May, just 2 weeks later. Also during Q4, we shortlisted and targeted a preferred list of insolvency businesses, and following discussions with numerous of those, we had a shortlist of 3, of which Consumer was firstly the largest and also our preferred target, as we mentioned at the recent fundraise. Again, we initially spoke to Carl Jackson, the managing partner of Consumer, on the 10th of June, and it was clear from the outset that we shared a vision in terms of how our data and direct marketing expertise could help to turbocharge their growth and accelerate what was indeed an already impressive growth trajectory. During June, having completed due diligence on Rand, we instigated a fundraise. This was initially for 7.5 million for the cash payment of the Rand acquisition, and due to demand and advice from our Nomad, it was later extended to 30.5 million, with an aim to essentially give us the surety that the funds were available and allow us to progress quickly to the completion of both transactions. So post a successful fundraise, we signed heads with Consumer on the 30th of June with a target completion date of the 31st of July. July was a busy month for us, as you would imagine. On the 1st, we completed the Rand deal. Throughout July, then, an intensive due diligence process was concluded on Consumer. And on the 31st of July, on time, we completed the successful acquisition of Consumer. And really, in doing so, created a group of high quality, well-managed, growing and complementary professional services businesses with the potential to leverage the client base and client acquisition strategies of each for the benefits of the wider group. Next 2 pages are really just some highlights on the Rand business. So Rand was founded in 2008, believed to be one of the longest, if not the longest, established specialist R&D tax credit company in the UK. Based in the Midlands in Derby, so centrally located geographically, acting for clients across the UK. About 25 staff and growing, including 2 shareholders who have remained with the business on a reduced capacity, but importantly, a second tier of 4 directors who have and continue to provide much of the day-to-day drive. Those directors now being properly incentivised with share option schemes and bonus schemes. The business very much shares our own low-cost operating model with one office and therefore high margins, typically achieving in excess of 50% EBITDA margin. One of the key attributes of that business, and one of the things we really liked about the sector, was that clients are typically contracted for 5 tax years, and therefore it has a circa 70% recurring revenue line year on year. The revenue model in that sector is that they charge a percentage of the client's R&D tax credit. So fees are typically anywhere from 2,000 to 50,000, with an average of about 8,000, and that typically represents 20% of the claim. So if they reclaim £50,000 for a client, the fee would be £10,000, and the client retaining 80% of the upside, the other 40,000. Rand is very much, in our opinion, a best-in-class, high-quality operator. One of the things that attracted us to it. Very proud to have a 100% success rate on claims submitted to HMRC. So over its 12-year trading history and over 2,500 claims submitted to HMRC, excuse me, they have a 100% success rate in those claims being successful. Rand has, over its 12 years of history, experienced year-on-year growth in both revenue and profits, very much premised on their existing model, which is sort of network introducer-led with little or no direct marketing. It's our strong belief that with our own data and marketing strategies and sales approach, that we can very much accelerate that growth significantly. Andy, just a couple of the financial stats on the opposite page.
These charts show that Rand has grown steadily year on year under its own steam with minimal marketing expenditure, relying purely on referrals to fuel its growth. Turnovers increased from 3.5 million to 4.3 million in the last 3 years, with EBITDA growing from 1.9 million to 2.2 million respectively. The first quarter for the year has seen a number of referrals passed from the group that John will talk about in more detail later. It's also seen a 19% increase in the number of claims filed with HMRC compared to Q1 last year. When we consider that these referrals through the group have only just begun, it's quite clear to see that there's much opportunity from this revenue stream going forwards. Next slides are on consumer. If I pass back to John for the business highlights.
Yeah, so similarly, just to give you an overview of the consumer business. So the consumer business is a high growth, mid-market, independent advisory firm. As the graphs across show, turnover has risen from sub 10 million in FY17 to in excess of 23 million in FY20. So excellent growth across that period. Whilst the business initially focused on the core discipline of corporate recovery and insolvency, it has more recently added both corporate finance, forensic accounting and expert witness services, and also pension advisory to broaden out the offering and create new and potentially high growth additional revenue lines. That being said, still circa 90% of the revenue comes from the recovery and insolvency business. Consumer has 17 offices across the UK, and whilst it currently has a southern bias to it, the growth prospects across the regions are certainly exciting, with lateral hires in some of those regions adding to the expansion of those areas. It also has international representation, currently has 2 offices in Cyprus and a joint venture in Mauritius, and there is a potential to look at expanding that overseas capability further. It has over 225 staff currently, and that comprises of over 30 what were partners that are now what we term managing directors, all of whom have welcomed the transaction and have transferred across from the partnership model into the PLC, and they're supported by over 190 directors and support staff that sit beneath them. Consumer's growth and success has been driven very much organically. Lateral hires, a couple of small acquisitions of teams to develop new geographies, combined with a client acquisition model premised on referrals from accountants and lawyers. And we plan to leverage that across both the tax and the M&A business, something which I'll talk to you more about shortly. Consumer, again, like Rand, is already benefiting from cross referrals from Kpis. As an example, recently a 15-branch travel agency that we were selling in the Kpis business, £500,000 of EBITDA, somewhere of that order. Strong interest in that business pre-COVID. COVID came along, the business dropped through the floor. Quite quickly, that business became insolvent, and we were able then to refer that into Consumer, and they've now mandated that client to act for them through a formal process. Again, just another example of the synergies and cross-selling opportunities of the businesses coming together. The other thing of Consumer was they had always craved a direct marketing, a direct to corporate, direct to SME offering in order to generate new client wins. This is something that very much came out in our early discussions with Carl Jackson, the managing partner there. And we're currently developing that direct marketing function, again, which I'll tell you more about on the strategy side shortly. Andy, just want to pick up the graphs again?
The graphs, just like the Rand ones, are relatively self-explanatory. As detailed during the Fundraise, Consumer has grown steadily year on year by recruiting new partners and making acquisitions of small strategic teams over time. Turnover has grown from 9.5 million in FY17 to 23.2 million in FY20, with a run rate that suggests there's more growth to come. It's important to note here that there's a highly prudent WIP policy in Consumer. As John mentioned, as part of the process, we looked at a number of competitors that we're looking at acquiring. As an example, there was a competitor with a very similar level of turnover, and the WIP was in the teens of millions. At the minute, we are sub £2 million of work in progress, so there's a clear benefit for upside without much downside going forwards. EBITDA has been normalised to add back partners remuneration historically, and this shows the equally impressive growth from 1.9 million in FY17 through to 4.5 million in FY20. The recent years have seen new revenue streams added to support growth, though restructuring still holds the vast majority of turnover and clearly is where the most opportunity is over the coming months and coming years. Back to John in respect to strategy.
Yeah, these are really just some of the key areas. I mean, the principle of the businesses that we bought is that they are all high quality, growing, well managed, businesses that have a strong future ahead of them. So this was never a sort of integration play of merging them all in together. These businesses will trade independently and, as I say, are growing under their own steam. The areas here in blue are really to talk to you about the strategy of how we're going to overlay additional layers of growth and try and therefore drive forward the sort of beneficial synergies of the overall group. So firstly, cross-selling, as we've mentioned, often a throwaway term, cross-selling, but actually it's real and it's happening already in the very early days of these acquisitions. The Kpis business is referring clients into both Consumer and Rand. Consumer is referring clients into Kpis Corporate and Rand, and there's a good number of opportunities coming out of that already. One of the key things here is, as an M&A business, we go out and see 600 potential new clients each month. There is clearly opportunities for us to refer a good number of those clients into Rand. We have many hundreds of businesses on the market at any one time, and again, we're able to, as we work through those clients, refer them into Rand, and indeed then when they're struggling, potentially refer them into Consumer for their turnaround and insolvency work. So a lot of cross referrals going on already. One of the key upsides going forward will be, which I mentioned earlier, was to develop this direct to corporate offering for both Rand and Consumer. Those two businesses have historically been built from accountants and professional services providers. What we want to do is take the direct marketing function that we have and that's driven the growth in the M&A business and replicate that across both brands. We do that through essentially recreating our Globe software and creating a Consumer Globe and a Rand Globe. So the Kpis Globe software, which matches the data and the direct marketing function, can be replicated at very sensible CapEx cost to allow those two businesses to benefit from significant investment and many years know-how, and therefore very much steal a march and do that very quickly. We're doing the Consumer one first because we believe that to be more time sensitive given the COVID situation and ending of the furlough scheme, etc. And then we will follow with the Rand one nearer the end of H1. One of the other key areas of growth will be around the introducer network. So historically, Consumer had around 300 accountant introducers. Rand had about 100. So as a group, we now have 400. But those 400 can cross-sell all group service lines. So whereas previously Rands were selling tax services, Consumer's introducers were just referring insolvency work, all of those 400 can now introduce M&A, tax and insolvency work. We're in the process of employing 3 or 4 business development managers across the country that will then be tasked with growing that network from 400 through 600, 800,000 and beyond in order to, again, drive bigger volumes of new client wins through that introducer network. Very much alongside of that, we're working on a number of sort of affiliations and partnership agreements. Same sort of argument as with the accountants. We pay away, happy to pay away a commission, an introducer's commission, and we're working with a number of bodies and organisations that are interested in promoting all group service lines across their members as well. Next one is around the corporate finance business. So Kpis Corporate clearly has its own corporate finance business. Consumer has a small corporate finance business in London within its offering as well. And we feel very much there's a benefit of combining those two corporate finance businesses together to take advantage of the northern and southern bases and also the regional offices that exist within the Consumer business. So we're looking to bring those two teams together over the coming months. Consolidation in terms of cost saving was never one of the driving factors of these acquisitions. However, clearly, when you bring 3 organisations together like that, there are opportunities. As an example, finance, Andy is in the process of sort of amalgamating the finance functions of the 3 businesses. And one of the benefits of that is that the interim finance director in Consumer will become superfluous in very short order. So savings, a significant 6-figure sum there in terms of his costs being removed from the business. There'll be other areas as well that we can look at as we move forward. And then in terms of Consumer itself, one of the key areas of growth is that continuation of lateral hires and potential of potentially small, looking at small acquisitions of teams in order to build the capacity of that business to deal with the demand which we see coming through COVID, coming through the introducer network, and coming through the direct marketing function which we're going to be implementing into that brand. So a lot to be working on in terms of driving some quite exciting growth ahead for all 3 businesses over the coming years. Andy, do you just want to click on? Do you want to cover that off, Andy?
Yes, this reflects the new board structure following the acquisitions. This is Carl Jackson, the former CEO, the now CEO of Consumer, joined the executive board. He brings with him a wealth of experience, including his time at Tennant. But in order to balance the independence of the board, Stuart Lees returns to his original position of non-executive, which is where he started out when we were first admitted to AIM. In addition to this, we're delighted to welcome Charlotte Strammer to the board. Charlotte's a chartered accountant and has significant PLC experience through her previous roles, including that as an AIM-listed CFO. Below, the organisational chart reflects the new restructure and the acquisitions. As part of the acquisitions, we've inserted a new holding company, K3 Capital Holdings. This was in order to issue growth shares to key members of staff and incentivise them on future performance going forwards. In terms of the name K3 Capital Group PLC, we're currently working with marketing and branding advisors and are considering a name change of the PLC in the near future to better reflect the new diverse group offering. At the minute, K3 Consumer Group is the front runner, but we're still in discussions with branding advisors.
Okay, moving on to then, current trading and future outlook. So KBS, the M&A business, has had an excellent Q1. So despite that standing start that we talked about in June and no retainer fees being recognised until the 1st of July, the M&A business is trading ahead of forecast. Revenues of circa 2.5 million in the quarter, with an EBITDA margin in excess of 50%, generating circa 1.4 million EBITDA before PLC costs. Rand again has had a strong start in Q1, as I think we mentioned. Submissions to HMRC 19% up on Q1 last year. And that's before really any of the client referrals and direct marketing has got underway. Hot off the press, week 3 in September was a record ever week for the brand, and they billed 200k in that week for the first time ever. So some strong signs of improving performance in the Rand business, or ever improving performance. Quantuma has only obviously contributed 1 month's performance to Q1, and therefore will contribute 10 months to the full year ending May. But a strong start in that first month, and a lot of excitement really around what that brand can achieve over the coming months and years, especially with what's going on in the world and the opportunities we've talked about in terms of marketing. All that leads to a Q1 performance of revenues of 5.6 million, EBITDA of 2.3 million, which is a margin of 41%. I think, interestingly, and something we have mentioned, is if we'd owned the Quantuma brand for the full 3 months of that quarter, then the EBITDA would certainly be well in excess of £3 million. Marketing and growth strategy is underway, as we've already talked about, and all that leading to a very exciting future for the group. And we believe a business that can quickly grow to in excess of 20 million EBITDA in relatively short order. I'll just pass you back to Andy to just talk briefly about dividends.
I thought it was appropriate just to talk a little bit about COVID mitigation, given where we are. I think if we rewind to March as events unfolded, it was quite clear that the world was facing an unprecedented challenge. As a board, we believe we acted swiftly and decisively to model a number of scenarios and establish where costs could be saved as turnover declined. The initial cost savings came from major cuts in marketing spend, as we discussed before, and overhead reductions. And to put that into context, the final 2 months of FY20, a total of £23,000 was spent on marketing, compared to a monthly average of £91,000 for the previous year. As part of the cost-saving measures, there may have been a number of potential job losses over time, but to stave off this decision, all directors and senior managers volunteered personal salary sacrifices ranging from 100% to 25% for a 3-month period. We also agreed to forego all annual bonuses for senior managers and directors. This contributed a £611,000 savings to the financial year. Subsequent to this, the Chancellor announced the Coronavirus Job Retention Scheme in late March. This allowed us to place a number of people onto the scheme, which also allowed management the time that it needed to understand the wider impacts on the national lockdown on the economy and our business and avoid making hasty decisions. We believe that we used this scheme correctly and ultimately has saved a significant number of jobs. With this in mind, as a board, we've discussed the merits of a final dividend payment in light of the post-share acquisitions, in light of the strength of the wider group, and also in light of the performance of Q1 FY21, and are therefore proposing a final dividend of 3.8 pence per share, subject to final shareholder approval.
Okay,
I think that's us.
Brilliant. Thank you very much, John. Thank you, Andrew. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. If you're accessing this on a mobile device, in fact, it will be on the underneath of the presentation slides. But just while the company take a few moments to review the questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be accessible via your Investor Meet company dashboard. I'd also like to remind you that your feedback is important to the company, and that immediately after the presentation has ended, you'll be redirected to the opportunity to provide feedback in order that the company can better understand your views and expectations. And we would very much encourage you to do that. John, Andrew, I guess before we look at those questions that investors had submitted, and we had, I think, three pre-submitted questions. If I could address those to you first, and then ask you to jump into the live Q&A. And if you could just read out the question and give a response where it's appropriate, if that's okay.
Yeah, great. So you're going to have the three.
Yeah, I'm going to read these out to you because obviously other investors won't be aware of the content. Yeah, sure. So the first question, are further placings due to take place to fund new acquisitions?
Yeah, I mean, there's nothing on the immediate horizon. I think we're looking forward to a period of sort of developing as we've said, the sort of data direct marketing and sales functions of the two businesses that we've acquired, and sort of proving the concept and the theory behind what we've done. I think once those are bedded in, we'll have a proven model, if you like, and certainly proven our ability to identify, target, and transact these type of deals with complementary professional services businesses. So certainly something that we would look at in the future, whether that would be done through a fundraise or through our own cash resources would very much depend on the size of the opportunity. But it's certainly something we'd be looking at going forward, subject to the success of these. Yeah.
Thank you.
Perhaps just to add to that in terms of funding as well, clearly both of these acquisitions were made on a debt-free basis with normal levels of working capital. They're both cash generative businesses, as is Kpis of old. Therefore, we did announce when we did the fundraise that we were slightly modifying our dividend policy to pay approximately 75% of adjusted profit after tax, which was down from 80% previously. The purpose for this was to ensure that we could have sufficient cash and working capital going forwards. These two acquisitions do have earn-out payments that are part paid in cash, part in shares. So this was to ensure that we've got enough cash to pay that element of the earn-outs and continue to pay what we believe to be still attractive dividend payments.
That's brilliant, thank you. The next question, what trends are you seeing in the transactional aspects of your business, and how do you balance that versus retained income?
Yeah, I mean, the balance of retainer fees versus transaction fees has always been an interesting one. As retainers are great in many respects because they cover all of our overheads within the business. And clearly, if retainer fee levels are good, then that translates to the fact that we're bringing lots of businesses to market, which ultimately is then good for transaction fees. I think that being said, we're a business and company sales specialist at the end of the day, and we firmly believe that an increasing percentage of our revenues should come from transaction fees. I mean, this year, as Andy mentioned earlier, approaching 60% of overall revenue is from transaction fees, and we would like that trend to certainly continue to increase. In terms of trends within that, I think we operate across such a broad spectrum of size, sector, geography, buyer type, seller motivation. It's difficult to really pick up on trends because it's such a broad church. I think the one key trend is that, and this is a trend that we consciously influence ourselves, is around what we term the bigger and better nature of those clients and those fees. Over many years now, we've been driving upwards the average client value and therefore average fee that we generate, and then that's jumped up very nicely this year. So that's probably the key trend and a trend that we consciously try and affect.
Thank you very much indeed. And the final question is about your sales pipeline. How are you looking to grow the sales pipeline, and where are the lead time, and what are the lead times, and what's your USP over other service providers? And I think that maybe takes a couple of the questions that have come in the live event as well, all around your differentiating offering.
Yeah, I mean, in terms of the M&A business, I mean, I think hopefully we've covered off how we're going to help grow the sales functions of the tax business and the insolvency business through utilising a lot of our methodologies. But how do we grow our pipeline? It's that funnel that we talked about, that hopper that we talked about before. It's really about the more opportunities we can put in the top of that, ultimately the more that come out the bottom. And it's about how we utilise the tech and the data and the software that we have to drive efficiencies and drive value out of that. So really, as per the funnel, how do we grow our sales opportunities? It's all around how we improve that data quality, how we apply that into our marketing function, increasing the volumes and quality of the marketing that we run. Training and developing our salespeople to be able to convert those opportunities into mandates. And then on the operational side, really it's around the buyer matching engine, and again, how we're utilizing that software to essentially drive more buyers into the top of that funnel, which ultimately leads to more meetings, more offers, and more completions. In terms of the question around timescales and lead times, it's a real difficult one there, because you can at the very best of our business, you can go and see a client one day, you can take them onto the market that very same day, you can produce the documentation quickly, you can gain interest in that business, and you can sell it within a matter of months. Equally, there are those that see us that take a long time to decide whether they're going to come to market or not. There may be another event happens at some point that motivates them to come to market. They might be waiting for a year end. Or whatever it might be. There's so many motivations of why people use our services that the timescales can vary. Equally, once they're on the market, the time actually taken to sell a business can vary greatly, dependent upon the speed at which that client provides us with the required information to produce the information memorandum, for example. So there's lots of outside factors that influence those lead times, and we just work on the principle of the KPIs. Everything is driven by KPIs, both on the sales and operational side of the business. In terms of USPs, they are many and varied, but I think some of the key things really are on the operational side, the service that we deliver, it's about the quality of the documentation that we put together. So the quality of how well we represent that client's business to prospective buyers through the teaser document, the information memorandum, is a key cornerstone of our service. I think more important than anything, though, is the buyers. Ultimately, if you're selling anything, the more buyers you can put it in front of, you're going to create a competitive environment then amongst those buyers. You're ultimately going to drive a better price because there's a competitive tension between those buyers, and ultimately you're going to complete more transactions. And again, I can never prove this because nobody publishes this information, but I would be absolutely astounded if any other corporate finance house or brokerage in the land is registering anything like 4,000 buyers a month, which is what we register at the minute through the utilization of that BME software and that piece of technology. And that really has driven, as I said before, a sort of 3-4-fold increase over recent years in terms of the number of buyers that we're bringing to the table. The more buyers that we bring, the happier our clients are. It's very much like when selling a house. If you're selling your house, what you want viewers to come through the door, because ultimately if you get a lot of viewings, you'll get offers and you'll sell your house for the right price. And it's very much the same principle here. So we're applying those same sort of disciplines that we have within the sales function of the business into the operational function to drive buyer demand, which in turn drives price and for our clients and drives conditions of sale for our clients, as well as helping us complete more transactions.
That's brilliant. Thank you. I'm also conscious of time. Obviously, we're just through the hour, and I know you've got a number of questions on the Q&A tab. And just to reassure the investors on the call today that the company will be able to review all questions and obviously publish responses where it's appropriate if we don't get through your question at this particular time. So perhaps, John, Andrew, I could ask you to start at the top and then figure your way through those questions. If you could read them out, as I say, just because no investor can see another one's question, and then give a response, and then I'll take back from you after that.
Sure. Okay. Well, start at the top. First one from Imran A. Do you envisage making any more acquisitions in the next 6 to 12 months? I think probably we've covered that off in the first of the pre-submitted questions. There's nothing on the immediate horizon. However, yes, there are other things that we would be interested in. There are other things that we feel would be complementary, but equally we feel there's a period of sort of consolidation required here to make sure that we've got these two new acquisitions bedded in and working properly before we divert our attention onto anything else. So hopefully that answers that, Imran. Next one from Jake D. What plans do you have in place for a second wave of COVID, and do you see this having an impact on your relationships with clients? I think the key thing, Jake, that the first lockdown taught us was that we can operate our business remotely. We've transitioned the sales side of the business, as we talked about, to be able to do that from home and do it remotely. And all of our people, have trialed and effectively worked from home and been managed effectively in doing so. I think because the business is very much KPI run, it is very easy for us to be able to monitor people's activity and output through those ways. So whilst clearly a second wave of COVID in whatever ferocity that might come, it isn't something that's welcomed by us. I think as a business, we've continued to build our robustness, if you like, to be able to cope with these things. And hopefully the graphs that we showed you there previously have sort of gone some way to show how we've become very resilient in our working practices and how we've dealt with what's been thrown at us so far. Moving down, Paul L is providing or brokering commercial finance an area of potential interest, and comments that one of our competitors does that. Yeah, Paul, it is an area of potential interest, and sort of that also ties in probably to debt advisory. It is something that that we have looked at, and would be something that we would consider going forward. Yeah. Mark B, typically what work are you expected to do in return for retainer fees? Essentially, this comes back to that sort of operational three-phase part of the operational process, Mark, in that the first thing that we're to do is to produce a set of documentation, which is typically what's called a teaser document, which is a generic description of the business used for marketing it without identifying which particular business it is. It's then the production of an information memorandum, which again would vary greatly depending upon the nature of clients. So if that were a Knightsbridge client, that might be a 10 or 15 page information memorandum, because it would be a low value and relatively simplistic business. If it's a Kpis corporate business, maybe 5 to 10 million in value, that might well be a 30 or 40 page information memorandum with full information about the opportunity. And as you go through into corporate finance, that can be a 60, 70, 80 page document, very, very detailed, written by the director in charge of that particular file. So that's the first piece of work. We then move into the buyer reach phase, which, as we've said, is around utilising our software and our data and our skill sets to interpret who the best fit of buyers may be for that particular client's business, and then obviously contacting those buyers and opening up conversations in relation to promoting that particular opportunity to them. We then obviously take those buyers through to buyer meetings. Again, at different levels of our business, we would sometimes host those buyer meetings and run management presentations. And at the lower end, sometimes we're just putting buyer and seller together, a little bit more of a matching service, but that depends on the fee value of the client. And then again, we're managing that process through, and that can be a very hands-on process through a corporate finance client with a large fee, and it can be very much sort of monitoring that and liaising with all parties at the lower end of what we do. So those typically are the services that we would see as forming part of that retainer fee, Mark. Paul, you've commented on Hilton Smythe. Looks like a direct competitor to the Knightsbridge brand, i.e. lower value deals. How similar are they? Are they partly taking space left behind as you move up the value chain? Any ex-K3C people? Hilton Smythe, we know they are, as you mentioned, a direct competitor to the Knightsbridge brand. Therefore, at the very lower end of what we do, we don't see them competing in the corporate world, which is obviously a far bigger slice. Just so you know, Knightsbridge last year was 16% of our revenues overall as a group, so not insignificant, but equally not a significant part of the business. They tend to operate more in what we term the retail license and leisure space. So shops, pubs, newsagents, convenience stores, all that sort of thing. Knightsbridge historically does do some of that sort of work, but more recently has moved into Knightsbridge commercial, which is more the sort of smaller versions of what Kpis corporate and Kpis corporate finance sells. We strategically moved the business more towards commercial a couple of years ago, as we feel there's a lot more synergy between the commercial business and the corporate business rather than the retail business and the corporate business. That's driven by the fact that a buyer of a £5 million engineering company might well also buy a £500,000 engineering company. It's very unlikely, however, that he's going to buy a fish and chip shop or a newsagent. So there's a lot more synergy and fit between the Knightsbridge commercial brand now, as that moves, as you say, up market, and possibly has left space behind it for others to play in that market. But we found the retail license and leisure side to be very competitive on fees. Therefore, margins were under pressure. And we saw it sensible to move more into the commercial space, which is where a lot of our experience and buyer data, etc., comes from. To my knowledge, there isn't any ex-K3 people there now. Mark B has asked a question: how many qualified insolvency practitioners does Quantium employ? Andy, I don't know if you want to pick that one up.
Sorry, I was muted. I don't actually know that number. I will find out though while you answer the next question.
I mean, roughly, Mark, I don't know the exact number. Roughly, there are 32 partners. Some of those partners are in central functions such as marketing, but most of those partners are qualified insolvency practitioners. So it will be somewhere between 25 and 30 would be my understanding. David B, will the company repay furlough before year-end dividend payments? David, I think as Andy covered off in the sort of COVID mitigation section, it isn't our intention to repay that furlough money. No, the sacrifices from the board and from the senior team have been significantly in excess of the support that we received from the government, and we absolutely feel that we used the scheme in the right way. We were potentially looking at significant redundancies across the business when we first locked down in March. However, the time that gave us to understand the impact, to go and raise the funds and to complete the acquisitions that we have done, and the performance that we're now seeing, and the scale and quantum of the wider group, we feel very justified in having taken that support, and ultimately then in terms of paying out the dividend going forward. And the last one that's on there at the moment from Scott M. How did Quantum and Rand cope with COVID? The flippant answer is very well. Both businesses closed all their offices and had all their people working from home, and saw little or no deterioration in performance throughout that period. The Rand business actually continued to keep the office closed right through until early September. And again, you've seen from the Q1 stats that we've mentioned already, is performing very well and ahead of last year, despite those challenges. Again, the Quantum business is a very similar story. The vast majority of those people still working from home, and therefore, again, coming back to the previous question around a sort of second wave, we believe across the group as a whole, we're in a pretty robust position where all of those systems and processes have been tested and proven to be effective in terms of people working remotely from offices.
That's brilliant. Thank you, John and Andrew. I think that's probably all of the Q&A that has been submitted during the live event. John, but perhaps I could just hand back to you just to wrap up, and then obviously I will divert everybody to give feedback.
Yeah, I mean, I guess this is the first time we've done the IMC presentation like this, so I hope you've all found that useful and interesting. I think from our point of view, this business has been transformed over the last few months from a market-leading M&A business that, whilst having a very robust business model compared with most M&A businesses, clearly faced some challenges in terms of the impact of COVID and Brexit and all the rest of it. And what we've done is we've transformed that group of businesses to now having a counter-cyclical insolvency business, having a high-quality recurring revenue model in Rand, and we're hugely excited by the forward-facing forecasts and the growth that we can hopefully drive through the business in the coming months and years. So from our point of view, hugely exciting times. Those of you that are shareholders, we welcome that and welcome on board, and hopefully it will be an exciting and lucrative ride for all of us.
That's brilliant. Thank you very much, John, and thank you, Andrew, particularly for updating investors today. Could I ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting via our platform, the feedback page will appear. If you accessed it via the link in the email, you'll be asked just to log back in and then provide your feedback. On behalf of the management team at K3 Capital PLC and Investor Meet Company, we'd like to thank you for attending today's presentation. That now concludes today's session. Good afternoon.